Hi everyone, it's Elizabeth Rose. I wanted to share with you today just a real quick overview of what's been happening in the financial markets and why interest rates have moved higher. You may have heard that interest rates have jumped up about 1%. It depends on, the details of your transaction, but about 1% overall since the beginning of May. And actually, they're probably a little bit higher than that. But here's what happened. Last year in September of 2012, get my years right, in 2012, the Fed came out and they rolled out their third round of quantitative easing, and we called it QE Unlimited. And the reason we did that is because it was pretty much like an open checkbook. They were going to purchase, or committed to purchase, $85 billion a month in treasuries and mortgage-backed securities. Our mortgage rates come from mortgage-backed security bond activity. Bond activity is much more volatile on a day-to-day basis than any given stock that you may be following. So the bond is already sort of a wild and crazy ride anyway. So they started purchasing $85 billion a month in both treasuries and mortgage-backed securities. And in May of this year, they started talking of tapering that program. You see, when they started it, they had no end in sight. And they had no dollar amount that they were going to gobble up, in $85 billion increments. So they started telling us in May that they were going to cut back on this program. They were going to start tapering it. And that's the key word, taper. And when this happened, it came out of the FOMC meeting. And then Ben Bernanke was talking about it. And from there, we started hearing from other Fed presidents around the country. And they all have different opinions of when to cut, how to send the message out. And really what Bernanke was doing is he was doing an open mouth piece, if you will, and sending the message to the markets in advance of something happening. And there's a saying in the markets, you buy on the rumor and sell on the news. And so this was, if you will, the rumor. And the bond market sold off, and investors took their cash and got out. And what that did is it caused the bond market to lose 956 basis points from May 1st to July 5th. That translates to over 2% in rate because it's a 4-to-1 ratio. So every 400 points, you have a 1% movement in rate. So we saw rates move from about the 3.75 mark up to nearly the 5 handle. So that's why it moved, is because of that market reaction to the uncertainty of this news that's coming out. And why is it uncertain? Because we don't know when it's going to happen. We don't know what it's going to look like. What do they mean by taper? It's anybody's definition. And so the markets have been looking from the beginning of May up till even today. They've been looking for some clarity of what this taper program might look like and when it might begin. And as we get closer and closer to the end of the summer, the chatter's becoming more lively that perhaps at the September meeting is when that first tapering will begin. And so anyway, the markets don't like surprises. Most of this surprise has now been baked into today's price, today's rates. And when the tapering does begin, it is very likely that the reaction will be mild because we've already sort of dealt with it. We've taken the gut punch, and now we're like figuring out, okay, it's coming. We know it's coming. We just don't know when and what exactly it's going to look like. So we have a little bit of that already cooked into today's rates. Now, here's what I want to tell you, too, about today's rates. Even if you are looking at a 5% rate, that's not a bad rate. That's a great rate. And here's why. If you look at the rates from 1978 to 1992, they did not drop below 9%. 9%. We're like half of that. And from 1972 to 2012, the average rate was 8.69%. Folks, remember, we're talking about 5% here. And to get a little bit more perspective, from 2003, when we were in the heat of the housing frothing before it got to the bubble that burst, From 2003 to 2007, the average rate was 6.06%. We're at 5%. We're at 4.75. We're somewhere in that little sweet spot. So rates are not bad. Rates are still historically wonderful. And if you want to know where they're going to go throughout the rest of this year, we may still see some upward movement, but I do believe it will be slight at best. I do believe that most of the reaction to the Fed's tapering has already been baked into where we are today, and so any upward movement from there is going to be small increments. But keep in mind too, the market does move in a very volatile fashion every single day. Rates move up and down, and your situation is unique to you. It's based on so many different pieces of criteria as to what your rate might be. But when you look at like the Freddie Mac benchmark rate and you see that it's moved up over the last 2 months, this is why. It's the chatter about the Fed and tapering their bond purchase program. So I just wanted to share that information with you today. I would love to hear from you. This video went way too long, but that happens sometimes. Thanks for staying with me, and I look forward to speaking with you soon. Thanks, and have a great day.